Hi, welcome everyone to my broadcast. It's 3T's Thursday, and instead of talking about tenants, toilets, and trash, I thought I'd talk about something even more fun, which is taxes. So I called it Taxes, Taxes, Taxes. The new tax bill just passed this week, and I'm going to go over with you how that tax bill will affect you as an individual for your own real estate, if you have a business, or if you're a real estate investor. So it kind of affects all three groups of people, even if you don't have a business, but you're interested in how it will affect you individually, either by the deductions you take, whether you have alimony, children, tax credits, things like that, whether you have your own business, or whether you have real estate holdings like our president, number 45. All right, so let's jump right into the content. I'm going to set it up for you with a tax bill. Are you guys ready? Okay, on Instagram, I'm not going to forget you guys. We're going to come right over and look at this, all right? So let's start with the 1040. With the 1040, I could not get 2017. It's not ready yet. So they have a draft form of 2017. Most of the forms I was able to get 2017. There's one of them, I think, that's 2016, but nothing really had changed. What's changing is from this year going forward. So let's look at the very first thing that changes. Gone are the individual exemptions. There is no number of exemptions for yourself, your spouse, or your dependents. You'll still choose your filing status here, but these exemptions will be gone on the tax form, not for this year, for 2017, but they will be gone when you file taxes next year. So I'm just letting you know what things will be different. Those will be gone, but you'll get a higher deduction later on, and I'll show you how that works. Okay, so what I've done is I've outlined in kind of reddish pink. I didn't have red for some reason in this particular program. In pink, what's changed, and then in purple is just forms that you should know about that would be very helpful to you. Hopefully it's in the middle. I'm looking at Periscope. It's not exactly in the middle, but I think I can change that. So hold on. Let me move it over a little for you guys. Okay, on Instagram, it's definitely centered. If you're on Periscope, I'd appreciate any hearts you want to give, or if you want to share this out, because you know your followers would be very interested in finding out about taxes for themselves as well. So let me get that over there, taxes. Okay. All right, so it's centered. You can see it pretty well. Thanks for the hearts, Roxine, right? You're still on. Great, great, great. Okay, so the first thing I mentioned, the personal exemptions and the exemptions for your dependents will be gone. Now, alimony is going to change, but it's not going to change until 2019. That's in pink on line 11. It will not be counted as income. So if you receive alimony, it will not be counted as income. I think they just finally decided that, income should only be taxed once. And it's being taxed on the person who receives the money. Whoever in the previous couple made more money is probably the one paying alimony. So if you're receiving it, it will not be taxed as income. Let's scroll down and see how that affects the person giving the alimony. That's on number 31A. You used to be able to adjust that and subtract it from your gross income, adjusted gross income. There will be no deduction starting in 2019. So you've got a year to kind of sort all this out. There'll be no deduction if you're the one paying the alimony. So you pay taxes on the full amount that you earn. You may not get to use the money, but you need to pass it over to the spouse who probably makes less than you. And then they don't have to count it as income as well, because you've already paid the full amount of taxes on that income. It's kind of bad for the person paying the alimony. And I didn't even hear the arguments on changing that. I just found that in the bill that we talked about. By the way, if you're watching the show, I will put a link to this on my website under the resources page, Wise Wealth University. I'll put a link to this document so you can look at it, and as well as a link to, there's a Google Docs, and I won't be able to show it to you. Well, I probably can. Let me show it to you. Okay, I want to give credit where credit's due. I got a link in my email from these CPAs. Hall CPA, it's a partner in limited LLC. So these are the three guys who wrote up this document. You can follow them all. I didn't transition over. You can follow them all on LinkedIn. Brandon Hall, I guess, founded the firm. So it's Hall CPA, Billy Withers, and Benjamin Ragor. They all prepared this document. And the document I will also share on Facebook, YouTube. I think I can share it on Instagram as well. And I'll put it on Twitter. And it goes over all the changes that are going to happen, the summaries, the key takeaways, things like that, that are happening with this tax bill. And because it's a Google Doc, I believe they will be updating it, from the final one. But I think the final part's already been updated. So I will share that document with you as well. So let me go back to the images here. All right, so that's where a lot of the information came from that I did when I made up this tax form. You should look at business income and loss, which is Schedule C. We'll talk about that a little bit later. The other purple line here are capital gains that will also affect you. Now, what I wanted to say about capital gains is they did not change the primary residence exclusion. So the primary residence exclusion, if you sell your primary residence, remains the same. In other words, if you're single, you can exempt up to $250,000 in gain, or if you're married, up to $500,000 in gain. And this is important for real estate investors because you need to live in the house 2 out of the last 5 years. And if you're not in the house 2 out of the last 5 years, you don't get that exemption, that exclusion from capital gains. Now, the other interesting thing about it is once you calculate it and find out that you have an exclusion and it's less than the required amount, you don't even have to fill out a form. You don't have to report it or say anything. As long as you're not over that amount. If it's over that amount, you have to put it on for capital gains. But if it's less than the $500 for married or $250 for single people, you don't have to put anything on the form. So that remains. They left that in place. They were thinking about changing it to 5 out of the last 8 years that you had to live in the property. So that wouldn't have been as good for real estate investors. I know some people like to move into a property, fix it up, and then sell it. So that kind of helps us out. The other schedule that I'm going to show you is the one for your real estate, royalties, partnerships, S corporations, trusts, etc. That's Schedule E. That's this pink, the long pink line there. So I'm going to show you Schedule, I'm not going to go over capital gains, but I'm going to show you Schedule C for business. And there's no changes on there, but there's changes on Schedule E. All right, let's go down. What else happens? The purple ones are things you should think about, but you may not have one set up. If you can and your employer offers it, you should set up a health savings account. That is not an FS. That's not a flexible savings account. It does not disappear at the end of the year. You can keep it and keep putting money into it and build up a health savings account that you can use later in your retirement. If you're in business, you should try to set up a self-employed SEP, simple or qualified retirement plan. You're allowed to put way more money in there than you are in a basic IRA. Again, if you're self-employed, you can get a health insurance deduction. So I went over alimony already. So those are the basic changes that are happening with income and deductions from the income or adjustments to the income until you get to adjusted gross. Now we move over to page 2. So the biggest change here is that instead of single people getting a standard deduction of $6,000 or married people getting a standard deduction of $12,000, they have doubled that amount. So single people can deduct $12,000 and married people can deduct $24,000 as a standard deduction. Now, these changes are probably the biggest changes that are going to keep people from itemizing their taxes. Because if your standard deduction is above what you could take if you itemized, then everyone's going to take the standard deduction. And that's really what they were talking about when they said, we're going to simplify the tax form. Because now you might not need to fill out the standard deduction. I mean, the itemized deduction. I'm going to go to that schedule, Schedule A next, and show you how they've reduced the things you can deduct on there, which actually pushes you more into taking the standard deduction than the itemized deduction. So there's some gains here, but there's some losses for people who itemize. The other thing they bumped up is this child tax credit. It used to be $1,000 per child. It is now $2,000 per child, but there is a limit of $1,400 total that you can get as an actual refund. So let me explain how that works. If you owe $10,000 in taxes and you have 2 children, you would be able to take a credit of $2,000 per child, which would bring it down to that you owed $6,000 in taxes. However, if you owe 0 in taxes, they're not going to just hand you money. They're only going to hand you up to $1,400 total as an actual credit that's above what you would owe in taxes. So they'll give you a credit to deduct it from what you owe, but they're never going to give you excuse me, they're never going to give you more than $1,400 if you have a zero taxes owed. So you can't have all your deductions, or you can't not make any money and just get a bunch of money because you have a bunch of kids. So that's not going to work that way. Remember, it was passed by the Republicans. So that's how that works. I think the child credit always has had a limit on what you could get back. They have adjusted the limits for I don't think earned income credit changed, but the alternative minimum tax changed. So they did change numbers on that. But that's based on every individual person's taxes. So I'm not going to go into that. Let's go over to the itemized deductions, because this is really what affects people personally. And they really need to know the difference between what affects them personally and what affects them as a real estate investor. So this part is, just is about everyone. So here's what itemized deductions look like. Medical has changed. So it's retroactive to this year, 2017. That's why I put retro, exclamation point. So it used to be that if your medical expenses were above 10% of your adjusted gross, in other words, you were really sick that year or had a ton of tests done, you could start deducting them as itemized deductions. They've changed it to 7.5% of adjusted gross income. So if you're above 7.5% of your adjusted gross, you can deduct them as itemized deductions. Just remember, if you're married and that doesn't total more than $24,000, you're just going to take the standard deduction anyway. Okay, now here's where they really kind of dug into us, especially for states that have high taxes and high real estate taxes and high income tax. So things like New York, San Francisco, LA, places like that, Alaska, Hawaii. Okay, so your limit in this box of deductions is $10,000. So no matter how much you pay in income tax or some sales taxes, and real estate taxes, whatever that total is, you can only deduct $10,000. So still, if that's way under the $24,000 standard deduction, you're not going to do it. the thing that puts most people into itemizing their deductions is their mortgage. If you don't have a personal mortgage for a personal residence, you're probably never going to get enough on this form that will make it worthwhile to deduct it in comparison to your standard deduction. So let me just take a quick break and remind everyone who I am. I'm Janice Bell. I'm a real estate investor, mentor, and coach. And my company, Wise Wealth University, takes the mystery out of real estate investing and gives you step-by-step training. If you enjoy the broadcast, please share it out on Facebook, like and subscribe on YouTube, and share it on Instagram. If you're on Periscope, please share it out to your Twitter followers, your Periscope followers, your Facebook followers, and we love hearts on Periscope. You guys all know what that means if you're on Periscope. All right, so let's go back to the taxes. So those are this box here, taxes you've paid, where it says limit 10K. That's income tax and real estate taxes on your personal residence. And also personal property taxes there are some states that charge you for different types of personal property that you have. I've really only had to do that when I owned businesses where I had computers and all sorts of stuff in the office. Okay, this affects people. The next thing is interest you paid for home mortgages. It's about mortgage insurance, points, all that stuff. They were going to limit this in the previous version of the bill to interest on the first $500,000 of any properties purchased after January 2018, unless you were under contract by December 15th, 2017. They have now changed it so the maximum interest you can deduct is on the first $750,000 on your loan. So if your loan totals $750,000, you can deduct all the interest. They were going to put $500,000, and many people in California and New York and lots of other places have much higher mortgages than that. So they put it up at $750,000. So if you buy a house for $1 million, you put down $250,000, your mortgage is $750,000, you can deduct the entire interest. When your mortgage is $1 more than that, you can still deduct the $750,000, the interest on the $750K, but not anything above it. Okay? So that was the change on mortgage interest. Let me scroll. Let me just tip the phone a little bit here. I've blown it up so big that I can't. Well, I'm gonna talk on the first one. At the bottom of the page where it says gone are a lot of the miscellaneous deductions. Okay, so there's two boxes down there. There's miscellaneous deductions, and they didn't specify whether they were talking about job expenses, but they definitely were talking about other expenses. Investment expenses, tax preparation fees, on and on like that. And then other miscellaneous deductions where you had to add another form and list them. So those are all gone. And remember, we're still just on the 1040 form, which I have to, which is at the top there. I'll just show you the bottom of the page. So hold on. All right. All right, so I'm going to bring it back around here. So, okay, so great. So now you can see that both of those miscellaneous deduction sections will be gone. They're eliminating that. And again, they may still allow this job travel, union dues, job education, and things like that, but other miscellaneous deductions will be gone. All right, so for a person, an individual, that's really how it's going to affect them. Now, most of us are on here because we either own a business or we do real estate, and there's a couple different ways you can do real estate. I'll come back on before I change the screen. So you can either be wholesaling, in which case you pretty much have a regular business without any holdings. And if you're flipping, you probably have a lot of your stuff in an S corp. If you're holding a lot of properties, you're going to use an LLC. Again, disclaimer, I am not a tax accountant. I am not a tax attorney, but that's what I've learned through my many years of investing in real estate, paying my accountant, and then adjusting the next year to figure out what I needed to do and which companies I should be doing certain things in. So let me go back over to the next form here. All right, let's scroll down. Actually, I'm just going to knock this one out first. Again, I'm trying to make this as big as I can for you, so let me move it down. Okay, this is Schedule C. This is where you would put a profit or loss from a business such as a sole proprietorship. So if you own a gas station, a restaurant, I put wholesaling there because if you're flipping houses, you basically have these kinds of car expenses, advertising, commissions, things like that, employee benefit programs, insurance, things like that, office expenses, rental, vehicle, supplies, taxes, licenses. Those are the things you might have, utilities. But if you don't own any property and keep the property, if you're only wholesaling, this is probably the tax form that you'd want to use unless you're doing it as an LLC. So this is really only for sole proprietors. So if you have a doing business as account with your county, and I suggest if you're just doing a couple deals in wholesaling that you start here before you go through the trouble of setting up an LLC. Because when you're not holding the property, there's very little liability that someone can come after you for. All right. Let's move on to Schedule E. And this is where you would put your rentals, and you would also put your information. If you have an LLC, like a single member LLC, and you're using that to hold your properties, you can elect to be taxed as an S corp, or if you have a partnership, and you would put all that income down here. So I'm going to go over that and show you how it works. If you have a few rentals and they're in your name or a sole proprietorship, you would list them here with all their expenses. So the big thing you need to know is, you see the mortgage interest. The mortgage interest is still deductible from all of the properties, each individual property. There's ABC. You can put 3 on each form. And then you also get to add a depreciation because it is a business asset. So often you have some that have a profit even after depreciation and some that don't. And eventually it all kind of balances out, so you don't really pay that much tax. When you do, if you do have a profit, you can deduct 20% of the income. This is a new thing. This is called kind of like the Corker Amendment. And he says he didn't really know exactly what was included, but it does benefit some members of Congress as well as ourselves. So whatever total income minus all the mortgage interest, you're not limited here because it's a business, and all the depreciation that you can put in for the property, that's the 27-year depreciation. You take all that income and you get to subtract 20% of it before you have to declare it as income on the front of your 1040 form. So that's where, because they dropped the corporate taxes from 35% down to 21%, they wanted to give something to people who don't run a C Corp but have what's called pass-through corporations. And at first I only thought it meant S Corps and LLCs, and I was thinking, okay, well, we got to move all our properties into that. But it also includes sole proprietorships. So no matter how you hold your rentals, sole proprietor, LLC, or you're flipping in an S Corp, all that information goes here and you get to deduct 20%. If you do run it as an S Corp, or you have an LLC that's taxed as an S Corp because it's an individual, you would put all that on here. And there's another form that you use if you have a multi-member LLC, because you have to divide up the income and send a K-1 to each person who's a member of the LLC. If you're a single member, you're allowed to put all the information right on this form. In fact, you can put them right here, or you can put it on an S-Corp form and put it right here. So this is mostly what we use for rentals and flipping. And again, you can deduct 20% of your income. So if, say, you have $100,000 in income from the business, you can deduct 20% of that, which would be $20,000, and you only have to report $80,000 on the front of your form. I'm going to show you where that goes. Let's go back to the front page. So down here where it says in the red here, the really long red line, rental real estate, royalties, partnerships, S corporations, trusts, attached Schedule E. We were just talking about Schedule E, so you'd put that, you'd get to deduct your 20%, and you'd put your $80,000 profit right here as income. So it goes right in that line. So that's how those two forms go together. All right, so that's basically it. If you're doing flipping or rentals, you would use this form. And if you're doing wholesaling, you're probably going to use just the sole proprietorship. It's a profit or loss because it doesn't really talk about the properties. It just talks about your business expenses because you never actually take title when you're wholesaling. If you already have set up an LLC or an S-Corp for wholesaling because you're doing a lot of it, that's different. Then you could use this form. So, ladies and gents, that is the entire tax bill, how it's changed, and how it will affect your life in 2018. So thank you all for joining me. If you have any questions, type them in the chat. If you do have questions and you watch the replay, I appreciate the hearts on Periscope, as well as sharing. You can do that on Periscope. And you can also put questions, let's see, on Facebook, YouTube. You can put a question on Twitter. You can't really put questions on Periscope after the call's over. But any other way that you want to contact me right here, you can ask questions. And I'll probably do the scope again after Christmas for people that were out shopping tonight, too busy to watch, because it's really important. It's going to affect how you go about your business. Now, there is a deduction that 20% includes another special deduction, which everyone thinks they put it in for Trump, okay? Because it allows you to deduct 2.5% of an initial purchase right when you acquire it. Not from profits or anything, just deducting it for buying the darn property. So if you buy a property for $1 million, you can deduct $25,000, 2.5%, right off the bat on that first year of taxes, and it really has nothing to do with the income, just from acquisition. And I think that's included in the total 20%. That won't be clear until the IRS works through all this and adds it all up. So anyway, if you would like the document with the link and the description of everything going on from the CPAs, that will be below the broadcast. And there will also be a link to the tax forms. And I will put, that's a PDF form, and I'll put those on my resource page on Wise Wealth University. So thank you all for joining. You all have a great Christmas. I decided to dress for Christmas tonight. I probably will not be broadcasting, maybe next week, something like that, because we're going to be taking a trip right after Christmas. So you all have a great Christmas and enjoy the holidays. Good night.